Welcome wherever you are, and indeed whenever you are, to this Fintech OS IBS Intelligence webinar, Next Gen Digital SME Lending. I'm Robin Amlow, Managing Editor of IBS Intelligence. Fintech OS is an award-winning end-to-end provider of software as a service-based front, middle, and back-office financial technology to digitally ambitious banks and insurers. SMEs represent about 90% of all businesses and more than 50% of employment worldwide, yet banks are still to find a quick and reliable way to serve small businesses. Historically, SME lending has been a high-cost activity, so how can the banking sector help SME thrive? The sector is critical to the global economy. So what can banks do to reduce risk and provide easier access to finance while at the same time making this line of business more profitable? During this webinar, we'll explore the current state of SME lending, investigate practical examples who's done SME lending right, look at how banks can improve SME lending, and use technology to act and react as fintechs. With me to discuss these issues are Catalin Dedieu, Vice President of Product Management, Fintech OS. Previous to Fintech OS, Catalin led transformation projects in financial services, working for consultancies the likes of the Boston Consulting Group and Roland Berger across Europe. Also, Ed Herman, Global FSI Industry Leader, Microsoft. Ed has got more years of experience in leadership positions at EY, HP, Cognizant, and Microsoft than he might want me to mention. His extensive experience also includes a focus on designing and implementing strategies to drive clients' digital transformation. And Todi Prutano, Vice President of Ecosystem Fintech OS. He's an experienced leader in the technology industry with a solid track record of 20 years in the business, including extensive experience at Microsoft. Welcome, panelists. We'll begin by taking our first poll and see what your thinking is. We'll leave this up for 30 seconds. What is the most important criteria for SMEs when selecting a lending institution? Personalized customer experience, tailored products, shorter time to yes, time to cash, or end-to-end digital financing? We'll keep it up for just a few more seconds. And so the answer, it would appear, is shorter time to yes, time to cash. Now, just a quick snapshot response from our panelists. Ed, if I could begin with you. Is this a surprise, or was it the answer you were expecting?
I think this is pretty much the answer that I would have expected. I mean, for SMEs in particular, right, getting a quick response time, right, and getting the funds dispersed is critical, right? Their cash flow is their lifeblood. So as things have changed over the years, and you know, with the pandemic, you started to see an even more urgent need to get that kind of a response time. So pretty much what I would have expected, although you do see a fair number of other responses in areas that are emerging, like the customer experience and tailored products.
Any thoughts from you, Todi?
I wanted to provide the same answer, but unfortunately panelists cannot vote. Pretty much on the same side we've had, particularly during these days. This reflects a very pragmatic approach that SMEs are taking towards financing, and also reflects much of the work that financial services institutions we work with focus on providing rapid access to financing.
And Catalin?
Yeah, very much agree with what was said, and this response doesn't come as a surprise. I think the current waiting times for getting to yes and getting to cash are very long, and they are long enough that they create a significant problem for SMEs that are typically in need for cash in the short term rather than 3 months down the line when they actually can access it. So yeah, I suspected as much.
Okay, thank you very much, gentlemen. We'll move on, and Catalin will stay with you, if we may. for your presentation.
Yeah, thank you very much, Robin, for the kind intro. I'm very excited to participate in this webinar today about SME banking, specifically about SME lending, as this is a topic that I'm very close to and I'm very excited about. I'm more than happy to take the next 10 minutes or so to explain why I think this is a very important topic for us today. So I have prepared a few slides. First, before we deep dive into what SME lending looks like and how can we fix it, let's just start by framing the overall SME banking opportunity, because we need to start from a context of how big the SME opportunity really is, or the SME challenge, if you will. So there are over, just to give you a sense of scale, there are over 25 million SMEs in the EU. They make up 99% of all commercial entities. They generate a significant amount of revenues for the bank, close to 1 trillion US. Their profit pool from a banking perspective is forecasted to grow significantly year on year with a CAGR of 7%. And perhaps, without deep diving into this further, also maybe good to understand how the European Union institutions define SMEs. The definition hits a couple of items, but mainly it's any company that's below 250 employees, and I think below an annual turnover of 50 million euros per annum. This is a very broad spectrum. This includes anyone that has a small company open to work as a freelancer, all the way to companies of 250 people, with the whole finance team, with the whole HR function, and so on and so forth. So diversity, quite great. Large number of SMEs, large, very big employer as a group, and a very big generator of revenues for banks. Now, with that context being set, let's deep dive a little bit into how are SMEs currently being served by banks, and more specifically when it comes to lending. So what we know is that there is a significant financing gap that SMEs, especially in Europe, are currently experiencing. We've seen some estimate that say there's a funding gap of 400 billion euros. That's 2019 level in Europe. In the UK alone, that's 22 billion pounds sterling. What's more important to understand is that if you look across all SMEs in Europe, around half of them will say that they are in need of either a bank loan or credit or a bank credit line in order to conduct their business. We also see that above 2/3 of SMEs that apply for loans do get a loan. However, there is a remaining 30% of SMEs that, even though they apply for financing, they do not receive it from banks. So we could probably say that there's a number of SMEs that, and we know this as well, there's a number of SMEs that don't necessarily apply for loans or credit lines because the hassle is too great. And of those who do apply, there's roughly 30% of them that do not get the loan or the credit line that they wish. Now, on top of that, we need to overlay the current context, and the current context is the global pandemic. We've seen surveys that were conducted mid-year last year that say 70% of SMEs in the European countries where the survey happened, so that's France, Germany, Italy, Spain, and UK, they say that their pandemic, 70% of SMEs say that the pandemic has hit their revenues. 20% of SMEs say that they're worried about default situations, and half feel that their businesses might not survive another year. So, there's a lot of pressure on SMEs, and more so than ever, I think they require the right type of access to financing. However, if you look at the reality of having to get a bank loan, I put on the right side, the right-hand side of the slide, some statistics that are granted, I think they are 2 years old, if I'm not mistaken, but they show how difficult it is to get an SME loan on average in the UK. So the average time to yes for an SME applying for a loan is 3 to 5 weeks. The average time to cash for an SME applying for an SME loan, for a bank loan, is 3 months. That means when an SME realizes that they might need cash, and when they usually realize that they don't have 3 months, it still takes 3 months for them to get access to that cash. If they manage to do it, they would only know in 3 to 5 weeks if they get access to cash, and then they would get the cash in 3 months. And this is definitely not helping SMEs that are, as I said, in need of cash now more than ever. So that is a very high level view of the context for SME debt financing. Now let's quickly talk about what are some of the main things that have gone wrong with traditional SME lending, and that led us to where we are today. And this is by no means an exhaustive list, but it probably signals the top 5 items that have sort of managed us into the context today. So number 1, SMEs are often overlooked and underserved, falling between retail and corporate. In many banks, we see that both the system and the processes serving SMEs either inspired or replicated from the systems and processes that serve retail customers, or from the ones that serve corporate customers. And none of them are optimized for SMEs because they are a very distinct segment. And there are even segments within segments with SMEs, but we'll talk about that later. But typically they do fall somewhere between either retail or corporate, who are the bigger, more lucrative segments in a traditional sense. Item number 2, missing credit ratings for small businesses mixed with inflexible legacy risk assessment technology. What that basically means is that you don't have sufficient data on some of the SMEs applying for credit, and your credit rating systems are not flexible enough to use the data that you do have to come up with a risk assessment measure. So there's a lot of SMEs that simply do not qualify, not because they are high risk in the true sense of the word, but rather because they are high risk because of missing data, and because the existing risk assessment technology doesn't know what to do with these particular SME types. Very connected to that point, we have rigid data systems that create information silos. So basically, when an SME is going through a lending process with a bank, through a lending customer journey, not all that data that is reflective of that SME is available in a centralized way. You're not able to personalize product. You're not able to quickly do risk assessment because your data lives in different information silos. Item number 4, legacy face-to-face interactions between banks and SMEs. This is a tricky one because while we are advocating automation and the use of data in the relationship with SMEs, we're not necessarily advocating the complete removal of a relationship manager. In some cases, we think that's actually useful and fruitful. However, even when you have face-to-face interactions, you want those interactions to be enabled by data. You want those interactions to be enabled by automated processes where whatever problem or task you want to solve for a particular SME, you can do it seamlessly. So first of all, as banks can remove a large amount of face-to-face interactions with SMEs. And for those interactions that they do keep, where they want to use a relationship manager, you need to have those face-to-face interactions enabled by data-driven systems that provide automatic responses and proactive sort of offers and products. Last but not least on the list is a barrage of regulation and credit constraints stemming from the 2008 financial crisis, as well as AML, KYC rules and requirements. This is a bit of an external in a sense, it's not necessarily up to the banks to manage it. However, there's good news here. We've seen pledges from the European Union looking to cut down on red tape and regulatory challenges. Last but not least, let's have a quick conversation about how we intend to tackle this at Fintech OS. And I think the guidelines here are general enough that they apply to everyone. It's not just the Fintech OS approach, but of course, this is how we look at things. So we believe that the key to solving the SME lending challenge has two pillars. One is personalization and two is automation. Personalization is very important for SMEs because even though traditionally we think about, when we say segmentation, we automatically think about retail. The reality is that the SME sector is in a much more dire need of segmentation, of a segmented approach than retail. Think about it like this. The SME segment encompasses both one-person companies as well as 250 people companies. It encompasses digital companies, that you have 3 developers working in an office, as well as a retail chain of many stores. So very, very different type of SMEs, and you need to cater your products, your relationships and interactions, and your risk approach to the different type of SME. So you need to personalize, and that requires you to, collect better data, understand who you're talking to, always surface that data, always use that data in your process, and so on and so forth. Second point, automation. Processes around SMEs and understanding SMEs and collecting data about SMEs as you're serving them are almost as complicated as serving corporate sometimes. But you can't afford the same amount of manpower because, of course, the unit economics don't make sense. So basically, you need to automate a lot of the interactions that you conduct with SMEs. And this comes at a benefit not just to the bank, where you decrease your cost to serve, but also to SMEs, where they want less hassle. When they apply for a loan, they don't want to manually give you all their financial statements, for instance. You can just connect to their financial accounting tools via APIs, pull all that data automatically. There you go, example of automation. So it's the delivery of personalization and automation that will dramatically reduce cumbersome lending processes and will automatically reduce, SMEs being left out because they're not aligned to old credit risk assessment technology. And the combination of those two is very powerful, where you are able to provide automated personalization, automated segmentation, automated processes that take into account specific profiles of the SME. I will only take 1 or 2 more minutes to explain how we do this, and then we'll move on. So we do this by building with data, and we do this through ecosystem integrations. So any kind of SME interaction that Fintech OS provides, any kind of SME customer journey that Fintech OS provides to our customer banks is built with data at the core. What that means is that a customer journey that is aimed at an SME will have access and will be able to surface and use any kind of data available about that SME from any type of legacy system, third-party database, the actual Fintech OS database, even data that is extracted to a customer journey is then used in the same customer journey for personalization and automation. And the ecosystem integration part, and this is very relevant and very dear to us, has to do with the ability to connect to the the service providers of SMEs, like financial accounting tools, like payroll tools, so on and so forth, connect to these databases and data systems through APIs and surface that data to the bank and throughout the interactions between the bank and the SME. And I'll stop here, given that we want to keep it this high level and succinct, and we can tackle a bit more in the panel that follows. Thank you very much.
Let's move on now then. Thank you very much, Catalin. And a reminder to everybody who's watching, if you've got any questions that you want to put to our panel, please ask them. We'll get to as many of them as we can before the end of the webinar. But let's begin our discussions right now with our second poll. We've been hearing from Catalin how it ought to be done, but which mode is preferred by SMEs for lending? Bank branches, digital banking channels, neobanks, or fintechs? Just a few more seconds, please. Right, well, if you haven't voted by now, you've missed your opportunity. And the answer, perhaps, again, unsurprisingly, digital banking channels. At least I hope it's not a surprise to any of our panelists. Ed, your thoughts?
Yeah, look, I mean, when you think about SMEs and lending, right, they don't have the resources to be able to, go and send people into the, bank branches, for example, and provide the necessary forms. So they're looking for the way to expedite the entire process. And an online experience is absolutely the way that it's been heading for a number of years. It's the reason that a lot of fintechs have arisen in this space, right? And it really ties in with the last question, right? Which if you can have a digital channel, right, and capture the entire application decision making, and then you get the funds dispersed, it all creates a seamless customer experience. So very much what you see as the future of SME lending.
And Catalin, this is the story you've just been telling us.
Yeah, definitely agree, and what Ed makes sense. I actually won't focus on that because Ed's reply makes sense. What I would suggest is that we all take a look at the 14% gathered by fintechs, which is an increasing number. It's not a lot, 14%, but it's probably a lot more than zero, which probably was a couple of years back. But yeah, the 58% digital banking channels doesn't, of course, it makes total sense.
Todi, anything you want to add to that?
Well, it reflects some of the statistics that Catalin shared before. What we witness is banks modernizing their SME lending capacities across channels. So of course, and I think that's also depending on the region. Digital banking takes a prime role, but as well we see customers that are reinventing the customer experience in their branch. How that looks like, how you can simplify the interaction while you can still keep more of an advisor role in the front of the client. So that 26% channel adoption for bank branches is still one to consider going forward.
Okay, let's move on. One thing that I did myself get from your presentation, Catalin, is that SME lending is complicated because of the wide variety of businesses that you're trying to manage as a bank and the approaches they come to you with. So can we truly say that SME lending is a growth area for banks? And if it is, why is it? All
right, I'll start. For sure, this is a growth area. First of all, there's again, statistics show there's a financing gap. So for any challenge, there's an opportunity out there that comes through differentiated product offerings, tailored offerings, and so on. Again, I would say it's very much a growth growth area, judging by the number of initiatives we see across types of regions and markets. So from emerging markets to very much developed markets, banks are investing into this. And also augmented by state, government-supported recovery plans, providing, enhanced financing support and enhanced regulatory environment for banks and other financing institutions to look more carefully at this audience, which is critical for economic recovery and so on. So to summarize, definitely a growth area, and digitization tools come just in time to make that a reality in shorter time than we witnessed in a previous economic crisis.
And what I would add to that, when you take a look just at the sheer statistics, right? I mean, there's a limit to the number of Fortune 500 companies that are out there. And when you go across geographies, it really doesn't matter what region of the world you're in. SMEs are the lifeblood engine growth, right? I mean, more companies that employ more people when you start to aggregate them all together. So SME lending is not only a growth area. As you come out of the pandemic, right, there's going to be businesses that fail, but there's going to be new businesses that are going to be a result of the pandemic, businesses that need to either restart, businesses that are going to grow, right, or new business ideas that have been created. So across different types of industries, right, across different geographies, you're going to see the need for cash flow, right? And as I indicated before, cash flow is critical for an SME business, whether that's a sole proprietorship or even up to an organization with a few hundred or a few thousand people. And therefore, there's going to be an expedited need, right, coming out of the pandemic for a lot of organizations, not only to just survive anymore, but how do we actually thrive and how do we grow? The last year plus, right, has been a little bit about just survival mode for many small SMEs. Now they're going to be looking for how do we grow? How do we come out of this? How do we hire new people? How do we purchase new assets? How do we expand growth, right? Whatever that happens to be. And therefore, banks are in a prime position, right, to be able to tap into that area of growth.
Well, I did say early on in my introduction that this is an expensive business for banks to be in because of the amount of effort they've had to put into getting SME lending right, if indeed they have got it right. So is it really profitable enough for them currently, and how can they make it more profitable? Catalin.
And I think, thank you, Robin. I think that question, hits the nail on the head, because one of the challenges with SME lending that banks have had, and in turn SMEs, is that it hasn't been that profitable to be, the sort of star segment and the star line of business for banks, because on the one hand side, they don't get, SMEs don't generate the revenues and profit pools that a corporate do at unitary level, but they definitely have a cost structure, a cost to onboard and a cost to serve that is quite high. Not as close to corporate, but definitely higher than retail. So all in all, your unit economics don't stack up that well if you're taking care of SMEs with manual, traditional cumbersome processes. So they probably, SMEs as a segment, don't rank up that high on the profitability scale. However, with the advent of technology, what we've been seeing and will continue to see is this automation of processes, this digital servicing of SMEs will significantly reduce the cost structure and will, in a short amount of time, increase the unit economics and increase the profitability that the SME segment will provide. And demand is there. Toddy and Ed said it before me, there will always be a need. There is a financing gap. The demand is there. It's now, I think it's up to the banks to significantly reduce their operational costs with, by using automated processes and automated servicing. And it's, hit two birds with one stone kind of situation, because all that automation is also going to lead to better customer services and better, just better servicing for SMEs. So I see this profitability as traditionally being somewhat low, but having the opportunity to go up quite high in the short and midterm.
Ed, do you want to add to that?
Yeah, and maybe a little bit of a counterpoint of view. I mean, first of all, I think Catalin was spot on with a number of those comments. But when you do look at the SMEs, they don't have the kind of bargaining power, right, that the large corporates do. So as a result, the SMEs do pay higher interest rate. Some of the fees, right, that maybe get waived by the big corporates because of their relationships, the SMEs don't get waived. So there are elements, right, of financial profitability for the SMEs. I think the need to improve their cost structure is always there, right? But if the banks are doing this right, it goes beyond just lending, because what's going to happen is the SMEs are going to need additional banking services, right? They're going to need a current account. If the bank offers something like cash flow forecasting, which is so critical for SMEs in their day-to-day operations, right? It's another service at the SMEs. So I think you have to look at it as the lending is just one part of the overall equation. And, are they profitable? A little bit comes back to how cumbersome, right, the lending process is, what the level of manual processes are that Catalin was referencing so clearly. Right. And if you can shorten that, you can get that more digital, you can drive your cost structure down, but you still have those other levers, right? Whether it's interest rates, whether it's, additional fees, and then it's volume. So, it's one thing to make a loan of, 100 million euros. It's another to make one of 50,000 euros. So you have to make a lot more, right, to the SME market in order for you to really have a profitable SME lending operation. So you've got to address a number of facets, right? Whether it's the operational aspects and costs, whether it's how we provide the functionality that's needed in the services that the SME is looking for. And it's also how do we transform ourselves as a bank to be faster and quicker and agile and respond to the types of loans that the SMEs actually need.
Anything to add there, Tony?
Well, I would like the fact that with support from digitization and having a data-centric approach to serving SMEs, financial services providers do have an amazing opportunity ahead. I'll just relate to one of the, I would say, future partners in our ecosystem. It's called UpSWOT, but similar to UpSWOT, there are similar initiatives in the market. What these guys do is they connect an SME account to multiple line of business applications, being the bank account, the payroll, the hiring application, and so on. Anything that can provide data insights about the dynamic of that enterprise, of that SME. And if that data becomes available to your banker, to your financial services provider, that has all the good intentions to support your business, the answer might not necessarily be a loan. There are various products that can be provided there, where a bank can take an advisor role, saying maybe you don't need that 2 million euro loan from our side, but what you need is, given your immediate cash flow concern, you need us to intervene here, or you look at a longer term challenge that an SME had, and to try to support from various angles. That has to be supported by data, and this is why Catalin insisted on this. Access to data that goes beyond traditional data systems that you interrogate when you do a credit scoring for an SME. Access to that data provides enormous power and is very much underused today. Luckily, there are so many application providers, line of business providers there that expose their systems. There are so many other technology providers that aggregate that data and make it available at the moment when a banker does a credit scoring or takes a decision. And this is where we do play a role as Fintech West, by the way. So I would say having that data first approach to how you embrace that SME opportunity as a financial services provider, having the tools to make that happen in the moment, that provides an enormous advantage. Also related to the cost structure, what I'm seeing in what we do witness, and we're working now with Microsoft in an initiative in the Middle East. Governments take a proactive approach beyond providing access to finance. They effectively want to build marketplaces where SMEs can benefit from a structure that provides easier access to multiple financial services providers, reduce the operational cost with SME verification and SME validation, and really create an opportunity for SMEs having multiple competitive offerings available for that SME. And I think we are just early days seeing those type of marketplaces evolve. And I'm keen to learn from their success in the next years.
Okay, let me circle back now to one of the results of our second poll. The question, just to remind people, which mode is preferred by SMEs for lending? And we saw 14% saying fintechs. Are banks actually in competition with fintechs in the SME lending market? Or is it the case that fintechs have a role where banks can't lend, whether it's for regulatory or credit or other reasons? Catalin, if you'd like to come back on that one to begin with, because I think you addressed it previously.
Yeah, so I'll first start with a big, with 30 seconds of me being pedantic. So when we mean fintechs, fintech OS is in a sense a fintech. So when we mean fintech here, we mean companies, financial technology startups or scale-ups that provide financial services. Fintech OS provides services to financial service institutions, which is a different thing.
So we're not talking about you. Okay,
yeah,
we're not
exactly,
talking about you.
Exactly. So I'm just I just wanted to get it out of the way and make sure there's fintechs can mean a lot of things. So I do think so. In the way the question was asked, I do think that there is competition starting between banks and fintechs. In some cases, it can be competition. So it can be complementary. But we do see companies that provide SME financing as fintechs, and they are not banks. And we even see it with some of the technology giants out there. It's not just fintech. So mind you, Amazon is offering SME loans to some of their merchants, right? And they do that because they have access to data, to build on Todi's last point. So Amazon has a lot of access to all the commercial data. So they have access to a lot of commercial data of their merchants. So they know who's doing well, who's not doing well, what their sales look like. And of course, it's very easy to make decisions on who to give credit to and who not to. And they're also integrated financially. So, the transactions just happen seamlessly. There's, companies like, funding circles. There's companies like, there's a lot of fintechs out there that typically address one niche or another. It's less common that you have fintechs going for the wider SME market. It's usually niche services, but very much so in their niches, they're usually providing good quality financing services that are because they're for a niche, they're personalized in a sense. And they're seamless. So banks will need to step up. I don't think they're really threatened in a big way by fintechs, but they will need to step up and keep up if they want to keep ahead of fintechs. Banks have trust, banks have brand, banks, they have a lot of things. They have the competitive advantage, but I do think fintechs are now a player in the market, and banks should be beware.
Hey, what I'd add to that, I think, is a little bit depends on how you want to define the market, right? And when you look at the origination of some of the fintech lenders, right, they started out going after markets that the banks didn't necessarily really ever chase, right? It might be just that small one-person coffee shop kiosk, right, that operates inside an office building. And they started small, and they started, on areas that banks didn't focus on. But as they achieved success, and those fintech lenders, got some experience, they got a little bit larger, they started moving upscale a little bit, banks started to take notice. And then when you layer into the fact that these fintech lenders take a very different approach, right? They utilize different data sets. They don't get the traditional forms of documentation that banks have asked for. So they look at different forms, or they look at different factors, right? And it could be social data, right? It can be cell phone data. All kinds of different algorithms are now deployed by the different lenders. So those fintech lenders, I think, have attacked a different part of the market, but they are moving a little bit upscale. The banks, in turn, have then started to look and say, okay, why are they being successful in an area that we never really thought we would chase? Because it takes us too long. It takes us 5 weeks in order to get, a request back for a 20,000 pound loan, for example. So where they didn't have competition before, I see the banks start to see some encroachment into their territory. But the other part that they see is the better experience that the fintech lenders are creating. And that's what somewhat attracts some of the SMEs. So not only the availability to go get a loan where maybe I couldn't get one before, because these fintech lenders look at different data points to evaluate my credit worthiness, but they look at it, it's so much faster, it's so much easier, I don't have to go anywhere, I submit it all electronically, the KYC checks are done electronically, forms are signed electronically. That all creates a better experience. So as a result, the banks see this slow but surely growing wave of fintech lenders coming, on the low end. You do have the big fintech guys, as you just mentioned, right? But I think you have to consider banks have started to look at how they serve those SMEs in a better way. They have created partnerships in different geographies, right? They've created partnerships. In other cases, there's been acquisitions. You look at what American Express did by buying Cabbage, one of the first, right, fintech lenders. So there's that slowly, gray area, right, that's becoming, a little bit more competitive. But at the same time, the banks still have the brand and the image that was just noted. And that's probably still the first choice for most SMEs when they think I need money. Let me go to the bank. It's just now they have choices to what to consider elsewhere.
Okay, let's move on. I'm conscious that time is ticking away. We've addressed in passing so far the elephant in the room, the pandemic. What's been the impact of COVID-19 on SME lending? There has been criticism that banks in various countries have not been efficient in delivering the support that they should have done. For example, coronavirus business interruption loans in the UK, or indeed offering repayment holidays, which were mandated by governments. What was the problem behind this, and how can it be fixed?
So I'll go first, and that maybe Tony wants to jump in afterwards, right? So I mean, I think first and foremost, it's some of the failures, if you will, reflect the lack of flexibility by the banks, right, in their systems and their processes to very quickly pivot to nobody can come and meet in person, nobody can provide forms, so they didn't have the digital channels available. Their processes were very manual. They didn't have the ability to turn up and scale up the volume, right, that was needed when you take a look at what actually happened right across almost every banking market. So whether it was the CIBLs or other form of government assistance, right, the banks were literally swamped, right? Every SME needed some type of assistance, some type of lending or bailout, and the banks, quite frankly, just didn't have the systems, the people, right, or the technologies in place. And so that ability to scale up, if they haven't been leveraging things like the cloud, they haven't been building out solutions that allow them to be very flexible, to be able to accept things on an expedited manner, to be able to scale up quickly. That really, I think, creates the big challenge for the banks, right? They have to have flexibility and agility and be able to pivot very quickly to respond to any type of a major need that comes on like that. In this case, most banks did not have that. Tony?
Well, thanks, Ed. I will not, go I'll just stick with your perspective and just add a bit more flavor to it, if that's okay. My experience with a country in Eastern Europe where the government took an important stance on SME financing support and programs in place. Talking to many bankers during that period of time, pretty much all of the SME departments were busy building those capabilities in order to adjust their systems to accommodate a new scheme that was supported by the government. So what that told to me was, you have to have that flexibility in your systems to be in a position to accommodate fast to an ever-changing environment. And this time it was a good change that was happening. It was not about increased regulation. It was about creating more flexibility for the SMEs in that market. How that translates at the end of the day into that capability that you have as a banker, modern tools, cloud-based solutions, easier or faster way to ingest data from various systems, easier to put in place new customer journeys that respond to those new requirements that the bank or the central bank would have. So I would say that on one hand, it was a good, coming back to your question, Rob, it was a good government support program, good intentions. Still, it took a lot of time to make that a reality for the end SME to say that, yes, I have a direct benefit out of that governmental support scheme. And that is because the devil is in the details, how you get that implemented at speed.
Okay, let's move on. Katalin, you actually mentioned this in passing, and this is specifically a question about the kind of fintech that you are, as opposed to one that actually offers money to SMEs. The European Union wants to support the SME sector, wants to encourage access to capital markets and venture capital. What's the role the banks play here? And also, what's the role that tech companies play in providing this kind of support? So that latter bit is for you, since this is the kind of fintech you are.
So the question, just to make sure I understand, is how do companies like ourselves support, increasing access to venture capital for SMEs?
And the capital markets more generally. There's two questions here, I guess.
Yeah.
One is, do banks have a role to play? And what's the role for tech companies, if there is one?
Well, there's a large role to be played by tech companies when it comes to facilitating access to venture capital and capital markets in general. I think this maybe applies a little bit less to us, not completely separate from us, but we primarily aim to help banks provide better financial services to SMEs and retail customers and so on and so forth. So we provide that flexibility and speed to market for new solutions and new products, and that accelerated transformation that was just mentioned in the previous question. It's less so about access to venture capital, which is a bit of a separate, somewhat manual process that startups and SMEs have to go through. We've gone through it for sure. The financial institutions, in that sense, the investors, that's something that has to do a little bit less with us. I think the other part of the question, which is how does technology help? It's, well, really, I don't think the banks, and with all respect to banks, I don't think that they have the capability to develop what they need to develop in-house in terms of technology. So they need technology companies like ourselves to provide out-of-the-box solutions and out-of-the-box capabilities to enable their sort of next generational technology and next generation of services and next generation of automated processes. So it was a bit of a two-tiered question. I think less meat on the bone for the answer around venture capital facilitation, which I think is is quite separate from, you know, traditional financing options. But in terms of how technology companies can help is, as I said, I think it's primarily technologies companies that should help banks, because I don't think any bank that goes ahead and says, I want to transform my entire technology stack and I'm going to do it in-house, I don't think that's the path to success. If anything, I think that's the path to to staying behind the trend and staying behind all the other banks and staying behind the competition. Hope that answer makes sense.
Robin, one thing I might just add to that is that, and it's kind of a sideways twist on what Caitlin was just saying, and that is one of the areas where fintechs can help, right? And some of them are in existence today, right? Is not every fintech lends, right, money itself, but instead they create, a marketplace, if you will, right, that matches borrowers and people or companies that have cash, right? Or they identified lenders that want to participate in almost a bidding contest, right? So one of the capabilities of fintechs is to help create these marketplaces that you can go to and apply, and then there's the ability of different lenders or different organizations that have cash to be able to look at your vulnerability or your needs, right, and provide forms of cash. So you're not going just to your bank, but instead you're going to these marketplaces. Tody, mentioned a marketplace earlier in a slightly different regard, but I think you're going to see more of these types of marketplaces so that you don't have to just go to a single bank. Instead, you can appeal to one of these marketplaces, and based upon your size, your need, your timing, right, there's multiple factors. There's different organizations, financial organizations, will be able to extend credit to you based on how they evaluate your needs.
Any thoughts on this, Tody?
Well, increasingly, access to financing means access is to different type of financial services providers. I think we focused a bit more on banks today, but Frank, it's quite obvious that the sophistication that exists in the market and new entrants in this market will only diversify the options for SMEs. Now, coming back to my previous statements, I think that is something that governments can do. Those type of marketplaces, even if you take pilots where banks initially and then other type of financial services providers can be part of, that would be a very useful exercise for our economy to take on. Now, the role of technology providers, is to make that happen now and not in 2 years. Because you see, our discussions are very much anchored in today's world, not in what will happen in the next 2 years. And if we see a pattern with consumers adopting at scale fintech and insurtech services, and you know it from various other economic sectors that first it's about the consumer, then it's about the business adoption, you clearly see a trend where SMEs, not just SMEs, will look at diversifying their access to financing needs and look for opportunities or look for solutions everywhere where they see the fit for that time to yes and time to cash to be as optimal as possible. So our job as technology providers is to make sure that, first of all, we establish a climate of trust with financial services providers, that fast does not mean risk, that fast can be positioned on top of policies, security, data privacy, and so on, and then partnering with those financial services institutions to make those offerings and those ideas happening fast in the market.
Okay, well, let's move on to our final poll now. And you all touched on this in your answers to my last question. So what financing product is most preferred by SMEs? Working capital, instant overdrafts, short-term loans, bills discounting, or I suppose that's factoring as well, is the same thing, bills discounting short-term loans, instant overdrafts, working capital finance. Another few seconds. And the polls are closing. Working capital finance by a long way. Is this something that gels with what you were saying earlier, Ed, about the kind of sources people can go to for financing that are non-bank?
I think it ties into just the overall, lifeblood, right, of the SME marketplace itself, right? They need money, right? And because there's seasonality, there's cyclicality, right? There's pandemics that happen, right? They have a need for, how do I finance my equipment? How do I finance my payroll, right? Depending upon what it is, I'm spending, opening up and expanding, new locations. So they need money, quick access to it, right? And they need it to, to be able to get to them in an expedited manner. So all these other categories, the short-term loans, the instant overdrafts, right? Again, that's an element of their overall financial flow. But I think working capital finance, right, is always going to be the clear leader. And in order to be able to provide that in an expedited manner, the banks need that, the digital capability to process almost everything if they can, digitally. They have to be able to turn around a quick decision. They need to look at alternative data points, come up with different forms of credit underwriting. They need to have that great credit experience, right, or great customer experience, I should say, for the SME market. They need to leverage the technologies that are out there and reconsider how you break apart the processes you have today and insert some of the new technologies like the companies like Fintech OS offer, right? That can scale up, that can quickly adapt, provide that great customer experience because it is agile, because it is repeatable, because it's simple, right? And they can get things to market. That banks have to be able to make change, pivot quickly, and give responses, but all while providing a great experience. And that all hits to the heart of working capital finance needs.
I've got to say, and I've left this up on purpose for people to see, that I am surprised that Bill's discounting is so low. That's just a personal opinion, but if anybody wants to tell me why that's the case, because it seems strange.
Well, what I would add on that is when you think about factoring, right, or Bill's discounting, right, a real an SME, a small proprietorship and everything, they generally don't have enough to get into the factoring, right? If you've got enough, right, you can look at the factoring. So it might just reflect more the fact of the SME marketplace, especially the lower end of that scale, just doesn't have the volume to be able to go through the whole factoring process. That would be my guess from the response in that marketplace.
Okay, let's move on to some of our audience questions now while we've got a few minutes left. In your view, what holds more promise for SMEs, a marketplace or an ecosystem? Thoughts on that?
Well, I would say many would say the two are synonyms. The idea of a marketplace equals, in my view, the idea of having multiple partners serving with purpose the need of the customer that interacts with them through that marketplace.
Okay, and ultimately, I was going to say, to your point, Tony, it depends on how it's structured, what services they're delivering, right? So the ecosystem is a network of partners, right, brought together maybe by an existing financial institution. A marketplace could be established by a fintech, that could be established by a bank, and they could just bring together, right, a number of different partners. Again, a little bit depends on how it structures, but there is a lot of overlap between those two terms.
And let's move on. How does a bank compare different automated credit decisioning platforms for SME lending available in the market? And how do these platforms compare with those available for retail customers? Catalin, do you want to take a run at that first?
Oof, that's a tough content question. So I think,
Sorry.
Yeah, I think, if you're looking at multiple platforms that allow you to process credit applications, there's there's a few things to look at, and it depends on who's buying as well. But I would look at speed to market. You know, how fast can you deploy it? Some of these things can be quite complicated, and you might end up with something that's holding you back for the next 6-9 months, or 12 months. So I would look at speed to market. I would definitely look at flexibility and agility. What do I have in mind when I say that? You're always going to want to change how you approach the process of giving credit and your risk assessment, and you get new data sources, and there's new startups that give you other data, and so on and so forth. And you want to be able to integrate new data and reflect it in your new process. And the same thing with regulatory changes, right? You want the flexibility to be able to integrate new regulatory changes and surface them in your new process quite fast. So to that extent, I would say the main criteria that I would look at that don't necessarily, they don't state the obvious. Is, yeah, of course, you need to be able to integrate a lot of data, and you need to come up with the best ways to do risk assessment. But on top of that, I would look at speed to market and forward-looking flexibility and agility. I think those are, on top of the obvious, metrics or criteria, whatever you want to call them. I think those are key to sort of mid and long-term success as well, if that makes sense.
And
go for it.
I'm sorry, I'm going to have to leap in there because we are actually out of time. So I'm going to ask each of the three of you if there's one message that you wanted to deliver that people should take away from the discussion we've just had. What would it be? And in one sentence. So, Ed.
I think banks need to take a very hard look at what aspects of their processes they need to transform in order to be able to respond to the market, to the SME market, and provide that better customer experience and the quick time to market for provisioning of the loans.
And from you, Tody.
Well, one thought, yeah. I had to prepare for that. I think, in general, I would rely on the fact that there's an enormous opportunity for financial services providers, banks in particular, to pay attention to newcomers in the industry, like us, that do promise a faster time to market with the type of solutions that we build for these modern times.
And Catalin, your key message.
I think, given that our audience is probably FSI centric, I think financial service institutions, with the advent of new technology that exists today, they have an opportunity to transform the way they engage with and provide services to SMEs, and they can do it in a much better way, which will be it really will be a win-win for everyone. So take that opportunity.
Okay, that's it. Just a reminder to all our participants, you will receive in your inboxes a copy of the white paper that accompanies this webinar. My thanks to Catalin, Vice President of Product Management, Fintech OS, Ed Herman, Global FSI Industry Leader at Microsoft, and Tody, also Fintech OS VP of Ecosystem. I've been Robin Amlo of IBS Intelligence. You have a great day.